Hi folks, welcome to this video on intercompany inventory sales and how to handle any intercompany profits from a consolidated perspective. So we have a problem here on January the 1st, year 2. The parent Pat acquired 90% of SAT, and at that time, the retained earnings of the sub-SAT were $1 million. There was no acquisition differential, so now we know that there is no goodwill. Pat uses the cost method, and we know that inventory sales only go from the parent to the sub, and they tell you that the sub sells at a 30% markup of the selling price. The intercompany sales were $160,000 in year 2 and $190,000 in year 3. We also know that by the time we got to the end of year 2, there were certain amounts that Pat, the parent, had not yet paid SAT, and that was $60,000, and by the time you got to the end of year 3, it was $50,000. So we know now at the beginning of year 3, Pat's inventory, because don't forget, the sales are all upstream from the sub to the parent. By the time we got to the beginning of year 3, Pat's inventory contained amounts purchased from SAT amounting to $70,000. So in other words, any of this $160,000 that was sold by the sub to the parent in year 2, the parent could not yet unload $70,000 of it. Whereas in year 3, the $190,000 that the sub sold to the parent, the parent could not unload $80,000 this year. In year 3, and we know the corporate tax rates are 40%. Now we're given here in this question separate entity balances at the end of year 3 for each of these companies, Pat and SAT. Notice that the retained earnings is at the beginning of year 3. So it asks you here to determine the amount that you would report on the year 3 consolidated statements given for each of those selected accounts, given all the information that you have in the question. And I'm suggesting to you that you might want to prepare an intercompany profit analysis and also do worksheet entries on the consolidated worksheet just to help formalize or structure your thinking and help you do your calculations for each of the consolidated balances. So now, let's begin our discussion. All right, so if we go back and have a look at what happened during year 3, we know we had intercompany sales. And don't forget, because we're looking for year 3 balances, we know those sales for $190,000, while they're totally earned by the sub-separate entity, they would be eliminated on the consolidated statements because the only sales that are legitimately considered on the consolidated books are any sales that were made to outside third parties. Well, if you sell it between related companies, they're not outside parties, so we have to eliminate that sale. We also know that by the time we get to the end of year 3, we have accounts receivable and accounts payable. So the accounts receivable on SAT's books and the accounts payable on Pat, the parent's books, there was $50,000 related to the intercompany sales. So therefore, because those payables are not with suppliers outside of the consolidated entity and it's with a related party, we know that they cannot be included in the accounts payable ending balance at year 3, so they need to be eliminated. So now, what can we do here? Well, to help us, we constructed an intercompany inventory profit analysis right here. All right, so we're going to focus here for now. And what do we see? We know that in year 2, there were intercompany sales of $160,000 from the sub to the parent. But by the time we got to the end of year 2, which is the same as January 1, year 3, the parent was not yet selling $70,000 of that $160,000 they bought in year 2. So, in that case, we know that the sub booked profit of 30%. So sitting in that ending inventory on a before tax basis is $21,000 of profit booked by the sub, that booked on items sold by the sub that the parent has not yet unloaded to a third party. So any of this profit has to be eliminated because it wasn't earned yet in year 3. Because of that, don't forget, the sub legitimately booked that profit, but the issue we have is that they also book tax expense on it. Well, if we can't recognize the profit on the sale, we can't recognize the taxes. And the after-tax income of the sub from a consolidated perspective only will be overstated by $12,600. Now, this is interesting. Why? Because whenever we have opening inventory profits that can't be recognized, we need to consider when would we recognize these profits. Well, because this happened as a result of a year 2 sale, we would recognize those profits in year 3, because by the time we got to the end of year 3, and don't forget year 3 is the year we are in, we would need to have sold. The parent, that is, would need to have sold to an outside third party the rest of that $70,000 worth of stuff that includes that profit of $21,000. So we would recognize that $12,600 on an after-tax basis, as well as the tax expense and the pre-tax profit in the consolidated books in the current year, year 3. We also know that by the time we get to the end of year 3, we know that the closing inventory of the parent included $80,000 of the $190,000 that the sub sold to them this year, in the current year, year 3, that the parent has not yet unloaded. So that's packing 30% profit. So now we have pre-tax profit, tax expense, and after-tax profit that will need to be deferred from a consolidated perspective. Why? Well, don't forget, the sub has legitimately booked this pre-tax and after-tax profit in its net income. There's not a problem with their separate entity books, but the consolidated entity can't recognize any of this profit until the parent unloads the $80,000 in goods to an outside third party, and that won't happen until year 4. So what we need to do here is we need to eliminate from the consolidated books the $24,000 in pre-tax profit, the tax expense, as well as the after-tax profit that at this point in time would be sitting on the sub's income statement. Notice here when we're doing an intercompany profit analysis, we always show who the seller is. So who was selling to who? In our case, we know sub sells to parent. The reason why we do this is because we need to make sure that when we're adjusting the consolidated books, we're adjusting the accounts for consolidated purposes for the original seller, in this case the sub. So now, I had suggested to you that if you wanted to, you could do the worksheet entries to help you kind of focus in on the worksheet entries. So, and to see how the accounts are going to, how the worksheet entries would affect the consolidation amounts. So the first thing we know is that because we're doing consolidated balances for year 3, we would want to make sure that we remove from sales on the worksheet the sales for the current year. Notice we're not touching the year 2 sales of $160,000, because don't forget, by the time we get to the end of year 3, any of that amount or any of those $160,000 in sales that happened in year 2, they were adjusted on the consolidation worksheet in year 2. So we don't have to worry about them in year 3. All of those goods by the end of year 3 would have been sold outside anyway. So there's no issue with sales. So because sales is in an income statement account, we're only looking for sales for the current year. So we're going to debit the sales and credit the cost of goods sold for $190,000, which is the amount of the intercompany sale from the sub to the parent in year 3. Now, you can see this isn't on any separate entities books because the original seller was the sub, right? So this would really be the sub's sales, and the original buyer, what a receiver of the goods, was the parent. And don't forget, when the parent, Pat, buys the goods, they put them into inventory or purchases, and that would increase their cost of goods sold, because don't forget, cost of sales is beginning inventory plus purchases less ending inventory. So if it's in its purchases, don't forget, the cost of goods sold would need to come down by that amount because you've included it in purchases, which is part of cost of sales. And because it's not to a legitimate third party, you have to remove it for consolidation purposes. Don't forget, these are only done on the consolidated books. Now, we also see from this analysis here that we have profit sitting in opening inventory for year 3 that we now need to recognize in year 3, because by the time we get to the end of year 3, that $70,000 has been sold by the parent to outside third parties. So in order to shift what I call a profit shift, to shift the profit from year 2 into year 3. And why do we want to do this? Because in the consolidated books, they can only recognize this profit from an opening inventory amount once all the inventory is sold outside. So presumably, by the end of year 3, any year 2 sales intercompany would have been sold by the parent to an outside third party. So we're going to remove or shift the profit out of the opening balance of retained earnings of the sub, which is where it was closed to by the sub, book the income tax expense in the current year, because don't forget, if we're going to be recognizing this profit pre-tax, then that means the consolidated entity would also book the income tax expense this year. And in order to recognize the pre-tax profit, we're going to reduce an expense, which increases profit. And in our case, that's cost of goods sold for $21,000. So notice the income tax expense and the cost of goods sold are going to help us accomplish our profit shift, because by adjusting these income statement amounts, it shifts profit into this year because the income statement accounts are still open. So now, we also need to eliminate this year's intercompany profit that was booked by the seller sub. It needs to be included in the consolidated statements when the parent unloads it outside, which won't be until year 4. So that $80,000 that wasn't yet unloaded has profit pre-tax of $24,000, tax expense of $9,600, and of course after tax $14,400. So what we need to do is eliminate the profit out of inventory. So we credit the inventory $24,000 and debit the cost of goods sold to remove the pre-tax profit so it doesn't get included in consolidated income. We also have to recognize that if we're removing the profit, we also, the seller, book tax expense. So what we would do in the consolidated statements is we would recognize that tax expense that's been booked by the sub as a prepaid tax. So therefore, we would set up a deferred tax asset, debit, and credit the income tax expense, because don't forget, we're removing the pre-tax gain of $24,000 sitting here in the cost of sales by adjustment. We would need to also reduce the tax expense, and that's $96,000. Now, the other thing I didn't do, but I can put it down here, is we would also have to make sure that we eliminate the accounts payable intercompany, and we know that amount is $50,000. And don't forget, it's actually the accounts receivable of the sub, right? That's $50,000, right? So this is accounts payable of the parent, and this is accounts receivable of the sub. Now, I don't require that you put the little p and the s in there. That's entirely up to you. If you choose to do it, it's not a problem. But I think the bigger issue is that you need to make sure that when you're calculating consolidated balances, you don't include the accounts payable. And if you had to calculate it, which in our case you don't, but if you do, you wouldn't include the $50,000 in accounts receivable of the sub on the consolidated books, because again, they're not they're between related parties, and we only want payables and receivables that we record, okay, with our outside parties. So now, with all this in mind, let's start calculating consolidated balances. Well, don't forget, to calculate the year 3 balance ending for inventory, we take the two separate entity amounts, but don't forget, the inventory, as we know it, includes $24,000. So the parent's inventory contains $24,000 in pre-tax profit, which we're going to eliminate to get $886. Our accounts payable, we take the separate entity accounts payables at the end of year 3 and we deduct the intercompany payable because it's not with a legitimate third party. And that gives us $1,070,000. We can also calculate the retained earnings at the beginning of year 3. Now don't forget in the question they gave you the opening balances, $2.5 million for the parent and $1.2 million for the sub. But don't forget, there were no intercompany dividends, no intercompany sales from parent to sub, so there's nothing to adjust on the retained earnings side of the parent. All of the adjustments will come in the sub side. Why? Because the sub was the only seller intercompany of goods. So if we're looking at their opening retained earnings, and we know that when we calculate consolidated retained earnings, because this is at the beginning of year 3, we know from the question that there were retained earnings that the sub had earned before the parent and the sub became related, which the parent can't lay claim to. So post-acquisition or since acquisition, we have $200,000 in post-acquisition retained earnings. In that post-acquisition retained earnings, don't forget, the sub booked an after-tax gain of $12,600, right, in year 2. Well, that doesn't get recognized until year 3. We're calculating a beginning of year 3 balance. So guess what? That has to come out of the retained earnings balance. Consolidated, separate entity, the sub is fine, but consolidated, we can't recognize anything into the consolidated books until year 3, when the opening year 3 inventory of $70,000 is sold outside. So therefore, when we make that adjustment, we get post-acquisition adjusted retained earnings of the sub of $187,400, but because we only own 90% of the sub, we can only take our share, which is $168,660. So if we add that $168,660 to the parent's opening retained earnings separate entity, we're going to get $2,668,660 as our consolidated retained earnings at the beginning of year 3. Our sales, you'll remember, separate entity, parents plus subs, less the year 3 sales that were intercompany, and that gives us $6.51 million. Calculating cost of goods sold, this is a little trickier. You include the parents and the subs, but don't forget, we set up here that when we eliminate the sale, we also have to eliminate the purchases, which are now in cost of goods sold. So to reduce that expense, we're going to increase our cost of goods sold by $24,000. And again, we also know, we're going to decrease our cost of goods sold by $21,000. Wrong number. And then don't forget, in the current year, we had profit that we had to eliminate from the year 3 books. So to do that, from an income statement perspective, we're going to increase an expense, which increases cost of goods sold by $24,000. So we're going to get $4,813,000. Your income tax expense is going to be affected by the profit shifting. So once we take the parents and the subs and add them together, we have to remember that we're going to reduce our income tax expense by the amount of profit that was booked separate entity by the sub, okay? And the income tax portion on that, and that's for year 3. So if we go back up here, when we eliminated the year 3 profit from the consolidated books, right, for this year, what happened? Well, when we eliminated it, we also had to eliminate the tax expense. Now again, the sub has legitimately booked it and it's not a problem, but the consolidated entity can't book any of this profit for year 3 until the goods are sold outside to independent third parties or legitimate third parties at the end of year 4. So in the year 4 statements, we will see this after-tax profit coming in, and that after-tax profit would be $14,400. So therefore, we make this adjustment to tax expense of $9,600 to lower it. But because we shifted profit into year 3 from the year 2 sale, and this was the year that the parent unloaded the year 2 sales of $70,000 that it hadn't yet sold at the end of year 2, but did sell in year 3, we now book the tax expense. So if you go back up here, you can see we've got this in our chart, our table, to analyze the profits right here, that line, and we've also got the profit shift happening here. So this is your tax expense adjustment of $8,400 coming in because we booked the gain, and that's going to give you $328,800. So this concludes our video on intercompany inventory profits and their effects on consolidated calculations. I hope you found it helpful.